Before we move on to yields on common stock, here's another example that I've worked for you to find common stock value using that constant growth model. So that's problem 9.2 from our textbook. So moving right along, we can find yields on common stock very much like we could find the yields on bonds in our previous chapter. We can find dividend yield, capital gains yield, and total return on a share of common stock. So before we work any problems in that vein, I'd like you to watch the concept clip in Chapter 9 video reviews that covers dividend yield, capital gains yield, and total return. After you've done that, I'd like you to recall the variables from our last mini lecture where we applied the constant growth model. For that problem, the last dividend was $2. G, that constant growth rate in dividends, earnings, and price, was 4%. R sub S, the total required return on that stock, in other words, that's the rate of return demanded by that stock's investors based upon the burden of risk that they have to bear. It's 9%. So based on all that information and our constant growth model, the equation for firms that fall into that category, the current expected price was $41.60. So we're going to use that information to find dividend yield, capital gains yield, total return. So the dividend yield on this common stock is found by taking its next dividend divided by its current price. Well, we know from our last mini lecture that if the last dividend was $2 and dividends are growing at a constant rate of 4%, the next dividend to be paid by this firm has got to be $2.08. So we divide that by the current price we calculated of $41.60. Our dividend yield is 5%. The capital gains yield is based on the change in price. So we would take next year's price divided by its current price divided by that difference divided by the current price. Well, let's leave that alone for now because I think there's an easier way to find the capital gains yield. The total return on this stock is equal to the required rate of return. It's given to us. It's 9%. That return is made up of the two parts, dividend yield, capital gains yield. So we have the total return of 9%. We have the dividend yield, we just calculated that, of 5%. So the difference there, the plug figure, is the capital gains yield. It's 4%. So we know that G is such a powerful variable in this model. It is the constant growth rate in dividends, earnings, and price. So certainly we can find all the dividends expected to be paid on that stock forever because it just keeps growing year after year after year by that G, by that little g. In this case, it's 4%. But we can find the stock's price in not just in current periods, in the current period, but also in future periods as well. Because, again, G is the constant growth rate in dividends, earnings, and price. So if the current price is $41.60, then the next price is going to be 4% bigger than that. And then the year after that, it's going to be 4% bigger, and so on and so forth. So if we want to find next year's price, we just increase the current price by 4%. Here's two more examples that I've worked for you to give you a better understanding of these concepts. It's problems 9.3 and 9.11 from our textbook. Now, sometimes R sub S not going to be given to us, but we can find it if we have enough information to find it. So sometimes we might have to use our formula for the CAPM security market line to find R sub S and go forward with finding all these yields. So I've worked problem 9.13 from our textbook to illustrate that. So go ahead and click on this link and you'll see what I'm talking about.